Okay, one more video for today. Again, we're gonna wrap up dealing with bonds. Okay, now whether we issued them at a discount or a premium, focus on discounts for the exam. Okay, so what happens when we get to the end of a bond though? Okay, so maybe our bonds 5 years, 10 years, 20 years, whatever. Okay, so we've made all our interest payments. Okay, so what happens is, again, someone has given us money. They've bought in a bond from us, so that's a promise to pay interest payments and return the principal payment at the end of the bond. Okay, so at the end of that term of the bond, we're going to give the bondholders their money back because our initial entry would have been debit cash, credit bond payable. There might have been a discount or a premium. Okay, depending if we sold it, again, at a discount or at a premium. Okay. Now, at the end of the bond, okay, now this is on page 938. At the end of the bond, we want to retire it, okay? So we're going to pay back the bondholders. How is that going to look? Debit, bond, payable, credit cash, because again, we're paying back the cash that they lent us, okay, or purchased the bond from us, okay? So that's bond retirement at maturity. And we see that on page 938. Now, if it's bond retirement before maturity, we're not really going to cover that, but we've got to pay back the cash, we've got to take the bond off our books, and then we've got to eliminate either the premium or the discount, and we might get a gain or a loss. But we're going to leave that for now. The last way to retire a bond would be to issue shares. So maybe we can't afford to pay back the $3 million bond. Okay, so let's just say initially the bond was $3 million, and at the end of 5 years we're going to pay it back. We can't pay it back. We have no money. So we might say, well, instead of paying the bond back, we're going to issue shares. Okay. Now, depending on your ownership, the value, the current market value of those shares, okay, you're going to get a certain number. In the textbook, they say to illustrate, the $100,000 par value bonds of Converse Corp with a carrying value of $100,000 are converted to 15,000 common shares. Okay, so what happens is you're just going to convert it, and you're going to know in the bond agreement if it's going to be convertible at how many shares. Okay, so you're just flipping this: debit, bond, payable, credit, common shares. Okay, and you've retired the bond. It's off the books. Okay. Now, again, there's a bunch of pages here giving us demonstrations of how we record the present value of the bond. Again, the present value of the bond is the face value and your interest payments. Okay. Now we're going to get into looking at long-term notes payable. Okay. Kind of similar to a bond. I mean, it has the same, it's a lending of money. So let's look at page 944. And this is slide, let me get to it. Slide 52. Okay. So a long-term note payable is a loan from a bank, maybe an insurance company or a pension fund. So we got to calculate the interest that we owe for each period. So what's the interest expense? How are we going to record that? Okay, it's simply the interest on the note times the beginning of period balance. Okay. Now there's no divide by 2 or divide by 4 if it's a yearly rate and we're paying it back once a year. So let's look at the example here: an interest-bearing note where the interest is paid at maturity. Okay, what we're doing is with an interest-bearing note paid at maturity. Now, there's a couple different ways, so there's options. Okay, where we might have interest and principal is paid at the maturity date, or we might have installments where we are going to accrue interest plus a principal payment or we might just have equal payments of whatever the loan calculation may be. So again, let's look at an example. We have an interest-bearing note paid at maturity. So let's assume Chipotle buys equipment on January 2nd, 2020 for $45,000 by issuing an 8% 3-year note. Debit equipment, credit notes payable. Okay, now what? So we've initially recorded it, as we can see on page 944. The company reports annual interest expense equal to the original interest rate, okay, times the beginning of the year balance. Okay, so we start with, in year one, 45,000 times 8%. That's going to be $3,600. Okay. So for the first year, debit interest expense, credit interest payable. Okay. Now, interest is calculated by multiplying each year's beginning balance by the original 8% interest rate. So what happens? We go from 45. Now we don't just owe 45,000. We owe 45,000 plus the 36. So now year two, we owe 48,600 times 8%. As a result, again, now we owe 3,088 in interest. Okay. And the total balance owing at the end of year two, at the beginning of year three, will be 52,488. How do we get that? 48,600 plus the interest. Okay. Now, that's in 2021. Or sorry, 2020. 2021. 2022. Okay. Now from there, again, we got more interest, 8%. Is 4,199. Okay. So the period's ending balance becomes next period's beginning balance. Because the balance grows by compounding, the amount of interest allocated to each year increases over the life of the note. So the ending balance will be 56,687. Okay. And we will pay that back. So 45,000 plus interest of 11,687. And we would accrue that interest over the period. Okay. Now, we also have a method of payment where we're making payments on a monthly basis or a yearly basis. Okay. So let's look at page 946. Now, accrued interest plus equal principal payments. So notice we start with a loan of $60,000. Interest rate is 8%. Okay. So, how does this work? Well, if we have equal principal payments, 60,000 divided by 3, that's going to be $20,000 per year, as we can see from the chart. But what's our interest going to be? Well, our opening balance, we borrowed 60,000. Okay. 8 times 60,000 is 4,800. Okay. As a result, the total cash payment will be 24,800. Debit loan payable or note payable, 20,000. Debit interest, 4,800. Credit cash, 24,800. What's left? An ending balance of 40,000 at the end of December 31st, 2020. So that 40,000 sets up our interest payment or interest expense for the next year. Okay, 40,000 times 8% is 3,200. Again, our principal payment's always going to remain the same, $20,000, but the interest expense will go down over time. So you can see in 2021 at the end of the year, we're going to pay cash of 23,200. Debit note payable 20,000, credit interest expense 3,200. Sorry, debit interest expense 3,200, credit cash $23,200. The ending balance is now $20,000. Okay, so $20,000 opening balance times 8% is $1,600. So again, this is the last year of the note, so we finally pay it off. Debit, note payable $20,000, credit interest expense $1,600. Sorry, debit note payable $20,000, debit interest expense $1,600, credit note credit cash. So I've been mumbling my words, so I'm just going to write it on the board. This is in year 3. Interest expense is $1,600, and we paid out cash of $21,600. Okay. So that's an example where our interest payments are always going to be different every month, or sorry, every year, but the principal payment will remain the same. It's always going to be $20,000. Okay. Now, there's also one more method, and that's dealing with equal total payments. So notice here, our payments were always different, right? In year 1, the payment was $24,800. Okay, then in year 2, it goes down to $23,200. And then in the last year is 21.6. So again, that's an example of an equal principal payments, because remember, this stayed the same. This was $20,000 principal payment every year, equals $60,000. We borrowed $60,000. Okay. Now the third example, what happens if we have equal total payments? This is how my truck payment works. This is how my mortgage works. Okay. Every month the same amount comes out of my bank. Okay, so we start with $60,000. This is on page 947. Okay, we borrow $60,000, interest rate of 8%. As a result, $60,000 times 8%, $4,800. Okay, we know our interest expense is $4,800. That's easy enough to calculate, right? 60,000 times 8% is 4,800. Okay. So, well, now what? Well, we got to figure out what portion is going against the principal, what portion is going against the interest. So this is our interest, okay? And we can see this from the table. So as a result, we take our opening balance, 60,000. So we know our cash payment every year is going to be, in this case here, 23,282. It's always B plus the C. Okay. So let's assume it says here. Let's assume that previous 60,000 note requires straight to make 3 equal total payments of $60,000 at the end of each year. So we still have to make that $20,000 payment at the end of every year. Okay. But what is the amount of cash that we have to pay? Well, the amount of cash that we have to pay in this case is $18,482. How did we get that? Well, so the credit, 23,282 minus 4,800. Now, how do they get 23,282? They're using their present value tables, okay? So if we have to figure this out, where we have total equal payments. Now, again, you're gonna have your textbook when you're doing a quiz, when you're doing an exam, so that's okay. So we'll take the 60,000 note, 60,000, okay? Interest 8%, 3 years. Okay. Now, table 14A2. Let's take a quick look at that. That is the present value of an annuity of 1 period. So that's what we'd use for an annual payment. Okay, so P over A. So again, they get that multiplier, $60,000, 8% at 3 years, 2.5771. So 60,000. Sorry, the payments are in this case here. Back here. I lost the page I was working on. Divided by, I don't know why I had multiplied, but 60,000 divided by 2.5771 is 23,282. So that's going to be our yearly payment. Okay, so if our yearly equal payment is always going to be 23,282 for 3 years, the interest for the year 1 will be 48,880. So as a result, okay, debit note payable, not non-payable. So in our first year, we debit note payable. In the amount of $18,482. Debit interest expense, $4,800. Credit cash, $18,482 plus $4,800 is $23,282. Okay, so that's year 1. Again, we always know that this is going to be 3 payments, 3 yearly payments. Okay, so in year 2, I'm just going to erase this. In year 2, we're setting up the same thing. Okay, the cash payment is still going to be $23,282, but the interest expense is going to be different. Why? Well, we no longer owe $60,000 on that note. Okay, we only owe $41,518. You might ask, well, how do you get $41,518? $60,000, which is our opening balance, minus the $18,482. That's going to be our ending balance at the end of year 1, which becomes our figure for year 2 to calculate our interest expense. 60,000 minus 18,482, 41,518. Now year 2 comes along. We only owe 41,518 times 8%, 33,321 of interest. Okay, 23,282, which is our annual payment. Okay. As a result, the note payable will decrease by $19,961. That makes sense, right? Because the more that we pay off over time, the more that we pay down our loan, the more is going to go towards principal. So lastly, same thing. Last year, $23,282. Okay. What's left on the loan? In this case here, we have 41,518 minus the principal payment of 19,961. The remainder is 21,557, and we know the interest what that's going to be, okay? Because that's the last year, so everything has to work. Everything has to be cleared out. Minus 23,282. 1,725. Okay. So that basically covers off long-term notes payable or mortgages. It all works the same way. Okay. Try the questions I gave you, and we'll take a look on Thursday at a correct answer or two. Okay, have a good night, or have a good day. Bye.